the issuer or any of its promoter group or directors or selling shareholders, like like I told you, there can be offer for sale. So some shareholder would like to sell their shares. If they are debarred from by the board, so then they can't go and raise money through an IPO. Okay, so second B, agreed. So that means if any of the promoters or directors of the issuer is a promoter or a director of any of the company which is debarred. Now, this is an indirect way of debarring. If suppose there is a promoter who is also happen to be the director of another company which has been debarred, so then the first company will also be debarred from raising money. Okay. See, now if he is a willful defaulter, that means he has taken a loan or anything and which is not returned to a bank, like again Vijay Mallya, he has been considered, he's been declared as a willful defaulter. Okay, so he can be debarred or he will be ineligible to make an IPO or an FPO. Okay, next. Offender. So now I'm just closing it. Even if you are an offender, okay, so you will be debarred. Okay, fine. So let's talk now here. Just read this again. So all these kinds of people, they are when they are debarred, so they are not eligible to make an IPO of any company in India. Whether you are a willful defaulter, whether you are a fugitive economic offender, or the promoter or a selling, they have been debarred, or I mean indirectly, because if you happen to be the promoter director of another company and whose company has been debarred, so the first company will not be able to raise. Okay, so these are the entities which are not, you cannot raise money to them. Okay, further. ESOPs. So now, if your company is going for an IPO, but you have some convertible debentures, okay? That means your debentures, on your debentures, you can have a right to get shares. So first, those, rights or debentures should be converted into shares. Then only the company can go for an IPO, okay? So a company which has certain convertible securities, they can't go for an IPO unless they have actually issued shares to those in lieu of those securities. Okay, except is ESOPs. That means the employee stock options plan. Now, whenever you join a company, so you may have an ESOPs where that means you will be eligible for shares of the company. Now, if you have an ESOPs, so these are just the exceptions. But otherwise, the companies which have issued, some convertible, kind of securities, they have to first complete their, rights, and then only the company can go for an IPO. Okay, read this. Now we are going to talk about who are the entities who will be now eligible to make an offer to the public. Okay, so this is very important. First, now there are certain regulations which says that only the companies which are profitable, which have certain asset criteria, they can only go for an IPO. So that means only companies which are sound, which are profit making, which are having some balance sheet items, only those companies will be eligible to make an IPO. So that means the first condition is that the net tangible assets, okay, should be at least 3 crores, okay, uh, in each of the preceding 3 years. So that means in the last 3 years, they should have at least intangible assets worth 3 crores. Okay. And then, of course, there is something monetary assets we'll talk about. So what is net tangible assets? Just read this thing, just go through this graph. Total assets minus intangible. Okay. And tangible assets are like plant, machinery, and this thing. So, okay. So, just read this. Okay. Now, let's go back to this, okay? So that means the company should have at least how much money should be in net tangible assets? 3 crores. Okay. Now, suppose if the company is having 3 crore net tangible assets, but everything is lying in cash. Okay. Suppose the promoter, he wants to come in IPO. So he has actually got a lot of money lying in cash and bank deposits. Okay. Just to fulfill the criteria of net tangible assets. So he can't do that because all the money should have been invested into assets of the company. They should not be only in cash, or cash equivalents. So what are the monetary assets? Just look at the on the right hand side. What are the monetary assets? Read them. Okay. So these are monetary assets. So you can have, these are also tangible assets, but not more than 50% should be in these assets. So let's take an example. So these are the monetary assets of the company ABC. So bank deposits, trade receivables, cash, short-term investments. So these are the 3 years which are given. So in the first year, 4.5 crores, second year, 6.5 crores, and third year, 7.5 crores. Now let's talk about the net tangible assets. Okay. Now this is the same company. If you look at the non monetary assets, 4.5, 6.5, 7.5 coming from here only. Okay. Now look at these assets. Fixed assets, is it a tangible asset? Yes. Intangible assets, 12 crores, that is copyrights. Monetary assets, 4.5. Total assets, it's the total of all the thing. Okay. Now, tangible asset will be how much? This 41 minus 12. So it will be 12, 29.5. Liabilities 13. Net tangible asset is 16. Just have a look at this. Okay. And monetary assets are the percentage. Okay. So I think I have made an Excel sheet. So I'll just show that. Okay. I should have actually opened that. Let me just search. Okay. Can you see this now? Okay. So this is basically, the total, fixed assets. So this is intangible assets, the monetary asset, total assets. So this total assets is what? Basically, I'll just share this also with you. So this is basically the fixed assets, intangible assets plus monetary assets is your total assets. Okay. Then tangible assets. So this is the tangible assets. So this we can also look. So this is basically 41 minus 12, which is 29. Okay, so these are liabilities, and then this monetary assets are coming from here. Okay, so these are the monetary assets. Fine, 4.5, 6.5, 12.6. So if you see here, monetary assets, so you can just make a this thing is coming from here. Okay, fine. Can you see that? So here also, if I look that, and here also, if I just put a arrow, so it is coming from here. Okay, all these are the monetary assets like bank deposit, trade receivables, cash, and short-term investments. Okay, so they are plotted here. Okay, now suppose I change the figure. Okay, suppose I say this is this figure to 5. What will happen? The figure will change to 32%. Okay, so monetary asset as a percent of the net tangible assets has gone 32%. So it can't be more than 50%. Okay, like suppose the cash balance goes to about say 45. What will happen? This figure will go to 63%. So as per SEBI, the monetary assets cannot be more than 50%. So the monetary assets have gone up to how much? 60.5 crores. Okay, I'll just remove the cursor here. So this, you know, because this asset had changed cash to 45 crores. Okay, fine. So did you get what I want to say that? Okay, ये कहाँ गया? I'm just bringing it back. Okay, so so these are basically the total assets of the company. Okay, so company has a fixed assets in the 3 years. Company has some intangible assets. Company has certain monetary assets which are coming from here. Okay, and then company has total assets, which is a total of everything. Then the tangible assets will be minus the intangible assets. That's the copyright and also we have minused it. Okay, so tangible assets हो गए. फिर total liabilities होगी उसको minus करा तो net tangible assets हो गया. So this is the net tangible assets. Okay, which is this. Okay, so now the law says that monetary assets should be less than 50%. So in the first case it is 50%, less than 50%. Okay, second year less than, but in the third case it is 63% because I changed the number here. Okay, suppose I make it to say 1 crore here. So in that case, the figure will be okay. So that means 32 crores. So this is what it says. Okay, I'm just moving back to my side, this thing. So I just read this again. Uh, just go through this Akriti again. So that means it should have at least 3 crores of intangible assets. Okay, in each of the 3 years. Okay, fine. And not more than 50% should be held in monetary assets. That means all your assets should be deployed in plant, machinery, equipment, so that the company is doing business. Okay, it's not just meeting out the criteria, it is bringing a lot of cash so that it can raise an IPO. Okay, so this is just to prevent that. Okay, so even if you have more than 50%, you have to make a plan and give a firm commitment that you're going to convert these monetary assets into other assets in a very short period of time before you come for an IPO. Before you issue shares to the public, you have to make this figure less than 50%. Okay, so in this case, if you see, the net tangible assets are below 50%. Is that okay? And they are all above 3 crores. In the first year, the net tangible asset is 16 crores. In the second year, it is 24.5 crores. In the third year, it is 24.5. So what should be the minimum figure here? 3 crores. So this company is meeting all the criteria. And the monetary assets are well below 50%. So the company is meeting out this criteria. Is that okay? Is that clear, Akriti and and Abdul? Is that clear? Okay. Now the second one. Read this. If the company is issuing shares only if it's making an offer for sale, that means it is not making a fresh issue. All the shares of the existing shareholders are being sold as a part of an IPO. then the monetary assets criteria is not applicable, because here the company is not getting any money. Okay, it is basically all the existing shareholders are offloading their shareholders. Okay, further. So here the first clause was regarding the intangible assets. Okay, so the company should have at least 3 crores of intangible asset. The second is the company should have be profitable. At least it should make a operating profit of at least 15 crores in each of the three preceding years, or the average should be at least 15 crores. For example, like this, if you look at this income statement of the company, look at the operating profit, the last one. How much is the operating profit in 2021? 22 crores. Then in the in 20, how much? 10 crores. 12. So this is the average, 15. So this is 22 plus 10 plus 12. So the average becomes 15. So this company is having an average profit of 15 crores in the last three financial years, and in every year the company is profitable. Is that okay? So if this is the state, then the company is eligible to make an IPO. Now let's आगे बढ़िए. हाँ, अभी करते हैं एक से. Abdul, just let me complete and you can just park your question for a while. I'll answer your question. Okay. Read this, Akriti. So the first one was, yeah, the net worth, total assets minus total liability. Okay, so that means there are three criteria, three main criteria. One is regarding the intangible assets, the second is with regard to operating profit, and the third is regarding the net worth. So the net worth should be more than 1 crore in each of the 3 years. Okay, for example, like this. If suppose this is the net worth of the company, so what is the net worth of the company in 2021, Abdul? In 2022? In 2023? And what is the criteria? How much the company should have? 1 crore. So that means this company is eligible for making an IPO, isn't it? Okay. Okay. So these are the three criteria. If the first is with regard to intangible assets, more than 3 crores, profitability more than 15 crores, net worth more than 1 crore. So if the company is meeting all these three criteria, then this company is eligible for making an IPO. Further, read this. Now, suppose if the company has changed its name, the company was earlier called ABC Card Limited. If you look at the right hand side, old name of the company is ABC Limited. Okay, and the revenue was 100 crores. Okay, and the new company which is called ABC Scooters Limited. The company has changed the name. The company has changed. That means company is no longer in car, but now it is only in two-wheelers. And what is the turnover? 150 crores for the full 23. So 60% of the turnover is coming from the new name. If that is the case, then the company is eligible for making an IPO. So now read again, Akriti, if it has changed its name. So is this right hand chart telling you the story? The company has changed its name from ABC Car to ABC Scooter, and the company's 60% turnover is coming with a new name. So if that is the case, the company is eligible for making an IPO. So ABC Scooters can raise the money through an IPO. Now, general conditions. So that means the first condition is that it has to make an application to the stock exchange, okay, for getting their approval that they are going to list the shares on a stock exchange. Now there is Bombay Stock Exchange, there is a National Stock Exchange, so there are two exchanges. So one should become your main stock exchange, okay, that is called the designated stock exchange. So the company should get an approval of the stock exchanges before it can issue shares. So it had made an application to one or more stock exchanges to seek in an in principle approval for listing of its specified securities, okay, and has chosen one of them as designated stock exchange. So this is one condition. Second condition, now all the shares had to be in demat form, okay. So it has entered into an agreement with the depository, okay, that the shares will be in a demat form. So now all the companies, all the shares are in demat. So this clause was, of course, had a great relevance at the time when companies were having paper shares also. But now all the shares are in depository form and in demat form. Okay. So now all the promoters who are holding shares of the company, they must be in demat form, okay, before they can make an offer to the they can make an IPO, okay, or they can file a offer document to the SEBI. So even the promoters should have their shares in a demat form. Now, some of the shares, even today I have a share of a company which are not in demat form. Of course, I want to get it in demat form, but those shares are not traceable. I kept it somewhere, but I am not able to locate them, but it is still in paper form. So similarly, the promoters can have shares, but they are not in demat form. So they should first dematerialize it, and then only the offer document should be filed with SEBI. Okay, last, forfeited. That means all the shares which the company has, they should be fully paid up. That means there should be no amount pending from the shareholder. If the amount is pending, then the money should be received from the shareholder, or his share should be forfeited. That means forfeited means his share should be cancelled. Is that okay? Is that clear? Okay. Now the last one, which is the most or maybe one or two more. Okay, fine. Firm arrangements. It has made firm arrangements. Now, this looks to be very complicated, this thing, but I'll just show you through example. Suppose there is a company whose total cost of the project is 2000 crores. Now, company needs 2000 crores. Okay. So, company says that we are going to raise this money out of these 2000 crores, 1000 through the proposed public issue. 200 crores because they have the money with them, they're called internal accruals. Okay. They have the bank balance with them. 800 crores, they're going to take loans. Okay. Now, so that means the entire 2000 crores, 50% of the money is going to come through public issue, 20% money they have got with them, and 800 crores they are going to take loans. Now, if the company wants to go ahead with a public issue, they should first get a letter from the bank that 75% of the loans which they are seeking from the bank, these companies, the bank is going to willing to lend the money to the company. Okay, if the bank says that we are going to lend 600 crores on their letterhead and they give this certificate and this certificate is filed with a SEBI, then only this company can go ahead and raise money for an IPO. Okay, so now it has made a firm arrangements of a finance to verifiable means towards 75% of the stated means of finance for a specified project proposed to be funded from the issue proceeds, excluding the amount to be raised from the proposed public issue or through existing identifiable internal accruals. So excluding the internal accruals and the public issue, how much is the amount? 800 crores. Out of that, 75% the company is raising the money through a loan. So the bank who is going to give the loan, they must give a firm commitment, okay, that we are going to give 600 crores to this company if they go and raise the money through an IPO. Is this clear? Okay, so you can just read it. It's nothing. I mean, this thing, once you read it, for you'll able to follow it. Okay, then just some more. Okay, we are going to end this thing. Read further. Now, whenever the company is raising money, okay, so it has to give a full account where the money would be spent. Okay, for what all purposes. Okay, like suppose this is the project. Okay, for 2000 crores. So the company wants to spend 2000 crores. It is coming for an IPO. So it will say that, out of 2000 crores, they are going to spend 1000 crores on plant and machinery, another 500 crores on land, and 500 crores general corporate purpose. So this general corporate purpose can be maximum 25%. So at least 75% of the amount should be clearly, said where they are going to spend. Only 25% they can say it is for general purpose. Okay. So read this. The amount for general corporate purpose, as mentioned in the objects of the issue in the draft of a document, shall not exceed 25% of the amount being raised by the investors. Is it clear? So 25% को वो रख सकते हैं कि जनरल पर्पस है, बाकी 75% they should give a clear picture where they're going to spend. Okay, but now if you look at this thing, how much is the plant and machinery, Akriti, and how much is the land, and what is investment purpose, and what is the general corporate purpose? No, no, you are meeting the 20% because it has to be minimum 25%. So it is 20%. But what they have said, investment purpose. Now, this is also, they have not clarified where they're going to put money. So the new amendment says, read this. So they say that if you are writing like this, then the general purpose and unidentifiable investment cannot be more than 35% of the total amount. So if this is the case, it will be acceptable. Investment purpose, you have not given any defined purpose where you are going to put money. 15%, it's okay. General corporate purpose plus the investment purpose should not be more than 35%. So this is okay. Is that okay? Now the last slide of the day. Read this. No, ऊपर से पढ़ो, eligibility. Okay, now, the companies which are not profitable, we have read so many criteria that they should have certain amount of intangible assets. They should be having certain kind of operating profits of 15 crores every year. They should have a net worth above, 1 crore. So, but many companies, they don't meet any of the criteria. For example, Zomato, Paytm. So all the companies were having loss-making companies before they came an IPO. So they were eligible to make an IPO under a category which is called alternate eligibility. Okay, what is that? Read this. So that means the companies which are not meeting any of the criteria which we have done, I mean, of course, all the financial criteria, and if they're not able to meet, they can still be allowed to take money from go for an IPO if they raise more than at least 75% of the money should be first offered to the qualified institutional buyers. That means the QIBs should give at least 75%. If the QIBs, which are the 13 institutions, if they are willing to give the money to the company, then the company can go for an IPO. Rest can be given to the retail investors. Okay, fine, or maybe 10%. So we'll talk about that later. So that means this criteria is, and they have to go through a process of book building. Okay, so they can't say that this is the price at which we are going to issue the shares. They have to go through a book building process. That means they have to invite bidding from the public. Okay, and then only they can go for the issue of shares, and they have to offer at least 75% to the qualified institutional buyers. If those qualified institution buyers, they don't subscribe to 75%, then all the money should be returned back to the investors. Is this clear? Now there are certain this thing I'll just show you. अब आपका काम अब होना है यहाँ से, अभी हम बाद में करेंगे. ये जो ऊपर ये लगी हुई है, यहाँ पर एक there is a site, this thing, so just copy this. So just copy this WWNSC, this thing, and go to this thing. So this is the last thing which we are going for the day. Go to Google, okay, and go to this site, National Stock Exchange. So you will do this place. Are you seeing this something on the screen? So this is a IPO corner. So current, past issues, upcoming issues. So it will give you full details of the, say, past issues. Okay. So now, so it will be like, all the companies which have raised money. Okay. Now it is security type. So make it equity only. Or we have SME, debt, Invitis, RET. So we're going to talk about all this, but let's go first to equity. Okay. So now we have all equities, all the IPOs or FPOs which have been there. Okay, all the companies like Quality, Political, Power, Electricals, Hexaware. So these all the companies, they have come with the issue price symbol. So issue start date, issue end date, price band, and date of listing. Can you see that? Now what you have to do is I mean, of course, you are going to make another project on the debt after you complete that. So you have to choose any company. Okay, any company. Okay, any equity. These are all equities. Okay, fine. So you can choose. I have chosen equity, but you can always choose any other. But you can choose. So last 1 year. So it will give you the last 1 year, whatever IPOs which are come there. Then you can just download the file. Okay. So like suppose I have Lakshmi Dental Limited. So you go there and you will have all the information with regard to the all the details of this company. The prospectus, everything will be there. So you can just download, and then we'll do all the analysis. What I'm going to do now is I'm just going to close this. Okay, we are going to just go through this site again later on. Okay, so this is the last slide we did. Okay, so then we are going to what we are going to do, we are going to do rest of the topics maybe on next week and next to next week, and then the last but one day we are going to do a case study where I'm going to take you through an IPO or FPO, and we are going to understand how the company has raised the money, and you have to do a similar exercise of your own. Okay, so that will be your take home paper or the last project carrying 20 marks. Is that okay? So अभी क्या करेंगे, हम पहले इसको complete कर लेंगे. Okay, so we'll understand everything about this thing, and then we'll go to the National Stock Exchange and first I'm going to choose a company and making you a presentation about a recent IPO. Okay, and then you have to choose one company and make a complete presentation, how the company, what was that company, how did they raise the money, what was the total amount of IPO, and why the company needed that money, where they spent that money. So it is a complete detail about that company will be given in that National Stock Exchange site. Fine, is that okay? So any questions, please? Is it clear? Okay, just read this last, I think one more thing. Is that okay? So this is what we did in an Excel sheet also. That book building process is a mechanism used for price discovery. Now the company wants to raise money. Okay. So they don't know at what price they should issue the shares. So they will, I mean, find out a price band with the help of the merchant bankers, and they are going to, tell them that what should be the price band, and within that price band, the company will, go and seek applications, bids from the public. Okay. So it will, the investors are going to make a bid, and finally, based on the demand, the final price, cutoff price will be determined, as we have seen in the Excel sheet. So how it was done. Okay, let's see. Okay, fine. So that's all. So if there are no questions, so we can just call it a day. Fine. So okay, then see you on next Friday. Okay, thank you.